All right, let's continue on. Let's talk about special property tax transactions. So we're still in that property tax section. This is where the government says, hey, we're going to giveth and taketh. What does that mean? It means you made money. Oh my gosh, that's great. Come here, buddy. Yeah, let me have my 39.6% or my 20% long-term or whatever it is. Oh, you lost money? Pobrecito, so sorry, not tax deductible. So this is where certain gains are taxable and losses, you just don't get them. For example, a wash sale. A wash sale is kind of you're playing the stock market. You're like, I'm going to make it big. I'm going to make it big. So you buy some stock. You spend $300 on the stock. The stock has gone down in value, so you sell it for $210. I have a $90 loss. Okay, that's great. Are capital gains, capital losses deductible, taxable? Yes, they are. However, what happens is it's a stock I really like. I like this company. So what I decide to do is I'm going to sell it, take the loss, but then I'm going to right away buy it back. So I buy it back for $200 because I bought it and went down. It's still going down. Instead of taking a $90 loss and then have a new basis of $200, government says if you buy this and you buy it within 30 days of buying or selling, that is called a wash sale. And you basically, if you had a gain, it's taxable. But if you have a loss, it's not deductible. What happens is you just have to add it to the basis of the stock. So instead of $200, you get no loss. Basis would be $290. So it says here, losses from wash sales are not deductible. If an asset that has been sold at a loss is repurchased within 30 days of the sale, the loss may not be deducted, but is added to the basis of the repurchased stock. This also applies to purchases of substantially identical assets in the 30 days, either before or after. So someone might say, in anticipation of selling this, I'm going to buy some more, and then I'll sell this one. Same thing. So here's 30 days, boom, this way, that's called a wash sale. Losses not deductible. What if you have a gain? Of course, gains, they're taxable. Losses from related party sales are not deductible. So if I sell something to a related party, if I make money, it's a gain. If I lose money, they go, sorry, it's not deductible. Now, before we go into this in more detail, what is considered a related party? And remember we talked about a dependency exemption, right? I like to do what? See the IRS jack you out of your money. How do you know if they're a dependent? They have to be a citizen, can't make much income, related to you or live with you the entire year, support and no joint tax return. As far as the related, we said if they're related, they don't have to live with you, but if they if they're related, they don't have to live with you. If they are not related, they had to live with you the entire year, like your cousin. All right, for example, here's me. Here's my parents. Here's my kids. Here's my bro. Here's my nephew. Here's my uncle. Now, and the uncle's kid is called a cousin. Now, for dependency exemptions, we said a cousin is not a relative, have to live with you the entire year. The rest of these people could be considered a dependent and not live with you. However, for this test, this is called related party sales. Sales of assets to related parties. These rules are a little different. Here what it says, parents, kid, bro, yes. But not uncle, not aunt, not nephew, not cousin. Those are not considered relatives for this, which means that if I sold it to them for a loss, I can take that loss. But if I sell it to a related party, parents, kid, bro, then that gain is taxable, the loss is not deductible. So what happens to the loss? Dual basis rules. Remember the gift rules? Let's say, for example, I have an asset, and let's say, for example, the carryover basis is 30 and the fair market value is 10. So what does this say? It says the dual basis. We don't know what the basis is until they sell it. So if I sell it to my parents, my kid, my brother, let's say I sell it for 8, then what do? I don't get a loss. They get a $2 loss. They sell it for 33. I don't get anything. They get a gain. They sell it for here, no gain or loss. So even though it costs me 10, it cost me 30, and it's only worth 10, if I sold it to someone else, I get a $20 loss. But if I sell it to a related party, I don't get that loss. I give it to them. They only get this loss or this gain. If it's in the middle, no gain or loss. Okay, so it's the same as the gift tax rule. Remember the gift, if someone gifts it to you, if it's gone up in value, carryover basis, carryover holding period. If it's devalued, that's when the dual basis rules apply. Same kind of rules. All right, so again, gains, taxed, losses, similar to gift tax rules, which is dual basis.